bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 27th, 2026 episode. As those of you watching on YouTube can see, my guest this week is Kelly Gorman, a partner in Novogradac's Clark, New Jersey office. Kelly is the author of the Novogradac Low-Income Housing Tax Credit Income and Operating Expenses Report, which we published earlier this month. Now, I always look forward to Kelly's appearance this time of year on the release of this report, because I'm always excited to review the report and tease out a bunch of data. Obviously, I'm an accounting geek and a LIHTC geek, so you can imagine how, when I look at a report like this, how many tidbits I end up looking at and analyzing. Now, as an overview, this report examines income and expense data for nearly 200,000 low-income housing tax credit finance units. The report itself is a summary of a lot of data, and in and of itself is 61 pages long. And in this report, we report on rental income, overall operating expenses, a variety of categories of operating expenses, as well as comparing them to historical figures over time. In this case, it's since 2016, so 9 year-over-years that we can look at. And yes, the income and operating expenses report is available for sale on our website. Also, Kelly has written several blog posts about the data and about what's in the report, and I will include links to all of this in today's show notes. But with all of that said, there's a lot I want to talk about today. So if you're ready, let's get started. Kelly, this is your fifth time on the podcast and a fourth straight year you've been on to discuss this report. And as I said in the introduction, I always welcome you coming back and discussing the report. So thank you for joining me.
Thanks. Happy to be here.
Now, before we jump into the report, I do want to give you a chance to tell our audience some of the many services that you and our valuation group provide to Novogradac clients.
Sure. Yeah. Like you said, I'm a partner in Novogradac Valuation Services, and the bulk of the work that I do consists of appraisals, market studies, rent comparability studies. We also do some other things like debt valuations, housing needs assessments, economic impact analysis, partnership interests. We do underwriting assessments to determine if proposed multifamily developments are feasible without tax exemptions. So those are kind of the highlights of the work that I do with my team.
Great. Thank you for that. Now let's jump into the report. Before I start teasing out a number of items that I want to discuss, and at the outset, I know we're not going to be able to cover this report in tremendous detail, but hopefully we'll at least do it justice. And I do encourage our audience to order the report and review it and share any ideas or any thoughts, observations you have from it. That's one of the beauties of a report like this. The more people that review it, the more interesting observations that surface. But let's start at a high level. If you could describe for the audience what we're measuring and some of the top level takeaways.
Sure, yeah. So this report, it has data on almost 200,000 units. To be specific, it's 193,783 units, and it's 1,754 properties. It's the 2025 report, and it has figures from 2024. In the report, we measure income and 6 areas of operating expenses. We look at administration, repairs and maintenance, utilities, payroll, management fee, and property insurance. We compare the data to the prior year, and we also measure compound annual growth rate since 2016 so that there is a long-term view. This year, the rental income, the expenses, and the NOI all set record highs. The rental income increased 8.7% over 2023. The expenses increased 10.5% over 2023, and the NOI went up 5.9%. In the report, we try and analyze the data different ways. We look at it by tenant type, geography, large regions, small regions, states, as well as metropolitan, non-metropolitan areas, building height, number of units. The report this year, we're always trying to improve on it where we can. And this year we have some new deeper dives on data from properties that have been part of the data set. We call that our same store data. as well as looking more closely at the two expense categories that have had the most dramatic increases in the recent years, and that's property insurance and repair and maintenance.
Thank you for that overview. And as you know, whenever I see the report for the first time, I'm always interested in how much did rental income increase year over year, how much did operating expenses increase year over year, and how much did NOI, net operating income, increase year over year. And I say that just from the standpoint of sustainability. And as we do modeling and such, what rates should we be assuming? And as you noted, income increased at 8.7%, which many would look at and say that is a high percentage annual increase. And we are serving affordable families, so we would prefer the overall rental income increase to be lower than higher. However, it does need to at least keep pace with the growth in operating expenses, which unfortunately it didn't, with operating expenses going at a faster rate, 10.5% year over year. Now, clearly, rental income is a bigger number than operating expenses. So even though operating expenses were growing at a faster rate, net operating income did grow on average across the data set, and it grew at a 5.9% rate. So before we talk about some of the implications of that and longer term trends, let's start with the overall rental income increase of 8.7%. I think most of the audience familiar with LIHTC knows that rental income is generally based upon limits by HUD. But if you could describe, what some of your takeaways are with respect to that 8.7% annual rental income increase, and unpack it a bit.
Sure. Well, we looked at the data, and we kind of considered the geography, and it looks like the rental income is greater in large metropolitan areas rather than small areas. The properties in the Northeast and the West received more rental income than properties in the South or the Midwest. Most states saw rent increases, but some of them did not, based on our data. And the 7 states and territories that didn't were Arkansas, Iowa, Missouri, North Carolina, Oklahoma, Virginia, the District of Columbia, and Puerto Rico. And we looked at that a little bit more closely to try and understand why those areas didn't see an increase. But those states have smaller data sets, and there are fewer units in the data sets, and there were some changes to the data sets from year to year. So maybe one year included different properties than the other. And we think because of that, that is kind of what's impacting it. But most areas did see increases. Another factor for the strong growth that we saw this year may be that some areas are still recovering a little bit from COVID and maybe some of the limits that they had to impose on their rents. And now they're recovering and they can apply larger increases. Some of the properties also could have subsidy and contract rents, and those rents may be above the tax credit rents. And so that may also be part of the reason why the increase of 8.7% might be a little bit higher than what you would expect for a tax credit property.
Now, operating expenses rose at 10.5%, and you reference property insurance and repairs and maintenance as 2 drivers of that. But share a little bit more in terms of some of your observations on operating expenses. And then I want to focus on a little bit longer measure period than 1 year.
Yeah. The impact, I think that the expense increase has been high, and it's partially due to the impact of inflation, because inflation impacts expenses right away. The rents can only adjust once a year, but the expenses could be changing every month. We also look at, in our report, the operating expense ratio, and that's the expense as a portion of income. And the operating expense ratio has gradually been increasing. It started at 54% of income in 2016, and now it's almost 62%. So expenses are definitely eating up more of the income than it was when we started looking at this data.
Now, I appreciate that. And when you look at the operating expenses at 10.5, rental, we'll talk about that more in a moment, but repairs and maintenance and property insurance were much higher than that. And let's just say they're bringing up the average in ways that we're wishing they weren't bringing up the average. And the fact that, operating income is a bigger number, it can rise at a slower pace, and net operating income can still rise and was a strong 5.9%. However, if rental income is growing at a slower rate than operating expenses, then eventually NOI will stop growing and even start to decline. And that's something that I always look at this report, and I'm always interested in what the compounded annual growth rate is over a longer period of time. And as you mentioned, our report covers 9 changes of income or 9 changes of expenses. And when we looked at that compounded annual growth rate, the report shows 5.1% annual increase in income over the last 9 years. It shows expenses, though, going up at a faster rate of 7%, with NOI growing up at 2.7% on an annual basis. So it's income growth, expense growth, NOI growth isn't as high as it was in this last year, but still expenses are more than income, which, as we were talking about preparing for the podcast, if that were to continue over the next indefinitely at that average, which of course it won't, that, in about 12 years, then the average property with these averages, and only we know for sure is no one property was at the average, then you would start to see NOI declining after 12 years, which obviously wouldn't be sustainable. You also mentioned inflation, and that being one of the drivers. And I will link to an article that I know you and I worked on back in 2022, where I actually went through and looked at how in inflationary times, that was obviously because we were going through notable inflation. And I was just observing how operating expenses can respond to inflationary pressures much more quickly. And in the article, which I will link to, I go through the various expense categories. Some respond pretty quickly to inflation. Others not quite as quickly, like utilities and things of that nature, where you have to go through a regulatory process for these expenses to be adjusted, and maybe property taxes and the rest. But I kind of go through each expense category and reflect all that. And I also note that on the income side, since, as you mentioned, HUD determines the maximum rent limit, and those get adjusted more recently only once a year in April. So rental increases are somewhat delayed.
Right. Yeah, we see it's usually around April 1st that the rent and income limits come out, but the properties generally don't impose the increases right away. Some won't for several months, or maybe even they might be a year behind. And it usually takes a few months before we start seeing the rents ticking up after the new rent income limits are released.
And I'm going to be interested to see over time to what extent those inflationary pressures on the real income catch up on the real income side, such that we don't have this sort of indefinite expenses going up faster than income, but it sort of dips down and income's going up a little bit faster than expenses for a while to bring things more into balance, which was the original goal of the incentive. Being mindful, of course, that the idea is to deliver the most affordable rents that a property can afford that are also sustainable based upon the need for rental income rising at least as fast as operating expenses.
And as you're mentioning, the income this year was at the highest year in our data set.
Yes.
We think also with the additional income that the properties are seeing, it allows the properties to make some discretionary repairs. And that also is a factor in some of the higher expenses.
No, that's a great point about particularly with repairs and maintenance, that by having more NOI, there's a number of repairs and maintenance and even additional services that can be provided that technically drive up costs, but there are costs that are a benefit to the resident. And some of that can get lost in our aggregation efforts here. So when I do think about these averages, then you look at it and you say, well, the data set that we just talked about is basically collecting the data from all the properties that we have in a given year. And when we look at that, believe it or not, the 193,000 plus units that we don't have all those units for every year. We have a subset of data that have been in the full term. And that subset you mentioned, we think of as same store properties. Please share with the audience what the annual and compound annual growth rate is reflected in our data for same store properties, or better yet, talk about how many units and the rest are in our same store database, and then talk about what the results were there.
Sure. Yeah. So this year we added a special section in the report on this data set. There are 55,000 properties, and actually, let me double check that if it's 55,000 properties or 55,000
I think
units.
it's 55,000 units.
Yeah, I think you're right. I'm a little, that would be amazing. That would be fantastic. Okay, maybe next year. But 55,000 units and 503 developments, which is about a quarter of the properties in our full data set. And these properties have been in our data set since 2016. So the data in this set is seeing income and expense increases a little bit lower than what it was in the overall data set. And we think it could be that these properties might be a little bit older. It might be the locations that they're in are slightly inferior. And so they're generating lower rents. And when we just to kind of compare the data, like the trends are similar, the income and the expenses are both growing, but at a more slow rate for the same store data. So for all of the data, we saw income increase at a compound annual growth rate of 5.1%. And then the expenses went up 7% and the NOI 2.7%. That's for the entire data set. But then when you look at just the same store data, the growth has been a little bit slower. The compound annual growth rate for income is 4.2 versus the 5.1. The expense is 5.9 growth versus the 7% for all the data. And then the NOI is 1.6, which is lower than the 2.7 for all of the data. So similar patterns, but a little bit slower.
Right. I just thought of it as a bit more muted and roughly, 1% less growth in income rate, roughly 1% less increase in expenses, and 1% less increase in NOI and a compounded annual growth rate. But I do want to emphasize that in our data set, net operating income on average did rise. It just wasn't rising in as fast a rate. And so in the sort of near term, there aren't really sustainability issues. Now, when we look at this underwriting and this sustainability question, and I did mention earlier that, if this delta between expenses and income continues at roughly 12 years for now, plus or minus, a property starts to have a lower net operating income. How does that affect, in your view, underwriting for LIHTC properties today?
Makes it very tricky. Yeah, it's difficult to know what sort of escalators you should use in your pro forma. And yeah, I wish I had an answer and I could say, oh, use this number.
No, it's definitely a tricky question.
Yeah.
And I do think the notion of, which is pretty standard in underwriting, having operating expenses growing at 1% faster than rents is a good sort of test. And
Yeah.
the fact that's been the case, roughly speaking, over the last 9 years, according to our data, I don't expect that would be the trend indefinitely. I definitely expect the trend will reverse, as I mentioned, this inflation pressure sort of working its way through. But it does validate the underwriting from a lender's perspective at a 1% delta between operating expenses and rental income to give that cushion for such a period of time where that was actually the case. But I don't think from a valuation perspective or a general expectation perspective, that delta would be the same.
Right. I agree.
And we'll see how well this ages over time. Let's turn now to operating expenses and the two big ones, property insurance, as well as repairs and maintenance. And as we have now noted many times in the course of this podcast, the average rate of growth of expenses in the database as a whole was 7% and was 10.5 year over year. And what struck me was most of the categories, the year-over-year increases were roughly 5% plus or minus, with the exception of two, if I'm remembering correctly.
Yeah.
That's insurance, which came in at a whopping 14.1%, as well as repairs and maintenance up 9%. And obviously the insurance at 14.1% definitely brought up the average in terms of the expenses as a whole. Repairs and maintenance at 9%. I look at that and say, to the extent some of that is being able to do work that maybe wasn't expected, but something that could benefit tenants, that's a kind of a net feature. And some of the repairs and maintenance can be a function of available cash flow. But I get ahead of myself. On the insurance side of 14.1%. Please unpack that a bit. It's something we've been talking about for many years now, and it's unfortunately not a new trend. It's something properties have been experiencing for quite a while.
Yeah. Yeah, you're talking about both insurance and repair and maintenance, and they're both taking up a larger piece of the pie. If you were to look at expenses as a pie, all the different expense categories, repair and maintenance went from being 22% of all of the expenses when we started looking at this data in 2016 to 26%. And then insurance used to be the smallest category. And actually, it was the smallest category. And when we would do market studies and appraisals with an expense analysis, it seemed like it was the easiest one to underwrite. There's often a plug that we would use of like $400 way back when. And now it's, I think, the hardest one to underwrite because it's just so variable geographically and it's increased so much. We really rely on the clients and ask the clients to get quotes for insurance. And yeah, insurance, it went from 6.6% of all of the expenses to 11%. It was the smallest category, and now it's the second smallest category. You know, as I mentioned, I think it does vary a lot based on the property type and the location. The reasons for the increase, the rates of increase are based on projections for weather events. And also, the premiums are tied to the insurable value of the property. So, properties that are more expensive to build, maybe a high rise property, might have a higher insurable value than a garden style property. It has elevators and just more expensive systems. When you look at the weather events, the data on weather events and how that has changed over time, the National Center for Environmental Information reported that there were 33 weather events in the 80s, 57 in the 90s, 67 in the 2000s. In 2010, there was a bigger jump with $131 billion disaster events in the United States in a decade. And that was followed by 115 more in the first half of the 2020s. We're not looking at 2025 data yet, but according to NOAA, I thought it was interesting, disasters were down in 2025, but we'll see if that has a more favorable impact next year. We did have the wildfires in California that started off the 2025 year.
So what are you hearing as you walk properties and you're doing an appraisal, you're working with your various clients? Discuss some of the ways they're dealing with rising property insurance. Because even the 14%, the real cost is probably higher than that.
Yeah. Yeah, there's definitely an insurance crisis in some parts of the country. And I think that's contributing to the affordability crisis in the country. There are providers that are pulling out of high risk markets. And this was, again, I mentioned California. This was all over the news last year with the California wildfires that people are having difficulty finding insurance. Owners are having to absorb higher deductibles and getting less coverage for it. Property owners are definitely looking at this category closely, shopping around. When we do our appraisals and our market studies, like we're constantly getting changes to the insurance amount because they're shopping around and getting new quotes. They're also, I think the property owners are also taking different measures to try and get coverage at the best rates. And that would include things like surveillance technology, apps that can measure water usage and maybe clue them in if there might be a leaky pipe that could turn into a flooding event, doing more preventative maintenance. And I think it's also impacting what they're choosing to construct and making the properties more resilient to disasters. And, I mentioned the variability and what the insurance costs are. The 3 states that have lower median property insurance costs are Utah, Iowa, and Arizona, and those are less than about 500. The state with the highest cost was Guam, and that average was 1793. And then the states that generally have the highest costs with median cost of at least 1,000 are near the Gulf Coast, as you would guess, Florida, Louisiana,
Right.
Mississippi, Texas, and then the Northeast, I think primarily because those states are probably higher cost to build, and that's Massachusetts, New York, New Jersey, and Pennsylvania.
So we
Probably
could
way
do a
more
whole
than you wanted to know about
podcast
it.
on property
I know.
insurance. And
Probably
maybe
too wordy.
you should come back and we talk more about that. But let's turn to the one other expense category that was year over year, substantial percentage wise above the average. And that, of course, is repairs and maintenance. Please describe kind of your sense of why repairs and maintenance are growing at that rate, and maybe share a little bit about historically how the repairs and maintenance costs have been increasing the last few years.
Yeah. A few years ago, we thought the expense for repair and maintenance has gone up a lot because of COVID. It went down that one year because they weren't able to
Yes.
do repairs. It wasn't safe for workers to get into the units. So they deferred a lot of the repairs. I would have thought it would have normalized, but it didn't. It's still been a category that's seen very high increases. It has 4 straight years of double-digit percentage increases. This year, it was a 13.8% increase over 2023. And when we look at the compound annual growth rate for that category, it's 9%. We've seen repair and maintenance increases that are significant for pretty much every type of property. I think it's tied to the record income and the ability to make some discretionary improvements or repairs, also tied to increases in construction costs and materials. Mentioned your article on inflation, and certain categories are seeing the impact of inflation more than others, and this is definitely one of them. And then, like I just mentioned with insurance, I wonder, is repair and maintenance going up because properties are doing more preventative maintenance to try and limit the insurance increases?
No, that certainly makes sense. I'm sure there's some of that. Just a question of teasing all that out.
Yeah.
Maybe one other area of expenses worth touching upon is utilities.
Mhm.
Describe for the audience what our data reveals about increases in utility costs.
So it increased, but the rate of increase was lower than the overall expense increase. Overall expenses went up 10.5%. As we mentioned, utilities went up 9.6%, and that's the highest of the years in the data set. And it compares to a compound annual growth rate of 5.6%. Remember, for newer properties, the utility increase or the utility amount is generally lower because the trend that we're seeing is that they separate the utility billing, and the properties often include less utilities in the rent than they used to. But properties also have been implementing more energy efficiency measures, including solar components, and that's allowed them to control the utility increase a bit. One potential issue that could come up is the sunsetting of some of the Inflation Reduction Act provisions that give tax credits for renewable energy. Those have been shown to lower the energy costs, and that's beneficial to both the tax credit tenants and what they're paying, and also to the property owners. So, with that changing, it's possible we'll see higher utilities.
Now, those are all good points. And I do wonder how much of the utility increases are just delayed, having to go through the rate base and those sorts
Right.
kind of inflation related, and how that might change over time. But as you point out, with the pareback and renewable energy incentives at the federal level, it can only have but one impact on utility prices. When you reduce the supply, or at least don't increase the supply as much as you otherwise would, utility prices are going to be adversely affected. Before we wrap up the podcast, and I could keep talking about the report, and there's so much more in the report and so many other interesting trends to be thinking about. And I know a lot of clients end up using this report as a way of benchmarking, trying to
Yeah.
look at what their properties are doing relative to what is aggregated in a report to help them in the whole underwriting process and budgeting process. But what else would you want to share with the audience before we bring this to a close?
Yeah, for our clients, as we've highlighted in the podcast, I just suggest that they look very closely at insurance and repair and maintenance. What are they doing at the properties? Shop around, get the best quotes they can for insurance. Make sure that they have good oversight and a skilled team making the repairs at the properties to help control those costs where they can. Implement whatever measures are possible. Again, the report's available. I encourage our listeners, our viewers, to go to our fancy new website.
Yes,
You can
our
see
fancy new
that
website.
front and center, there's information on this report. You can buy it in different forms, hard copy, digital, through our Novico Knows app. I'm interested if people have questions or feedback. I'd love to hear it. And on our fancy new website, you can get to my V card with my contact information. So I'd love to hear from people. And I hope it's a useful tool for folks.
Excellent. Echo all of that. And we'll add a note of the items that we mentioned in the course of the podcast in today's show notes. Please stay around for the off-mic section, which I'll get to in just a moment. But before that, I'd like to say to the audience, as I do say every week, if you're enjoying watching and or listening to the podcast, please subscribe and tell your business associates about it. Please also take a moment to like the podcast. I'd appreciate that very much. And please help us develop future shows by emailing any programming ideas you have to cpas@novoco.com. So now we'll turn to our off-mic section, Kelly. And as our regular listeners know and viewers, we'd like to use this space to give a shout out to others who are working in the tax credit and tax incentive communities. And it's an opportunity to highlight a professional worthy of recognition. And sometimes we focus internally, and most of the time we focus externally. So Kelly, who would you like to shout out?
So I would like to shout out to Brad Stanhope and to Rob Valdez, who were instrumental in the making of this report. I appreciate all of their efforts. And then also, as I mentioned, our fancy new website, all of the folks that worked on that. I know that the marketing team and What's Next Innovation spent a lot of time trying to perfect the website, improve the user experience. I love the news section that's on it, front and center, and you can see what's new with Novogradac. We can inform clients and our colleagues of what's important in the industries that we work in. I think it just looks really cool. I'm really impressed with it. So I wanted to give a shout out to those guys.
Well, let me echo that shout out as well. And it was a great way to kick off the year a week plus ago, or a week ago exactly, or 2 weeks ago.
2 weeks ago when this airs, right?
Yes, exactly. Two weeks ago when this airs, a week ago when we're recording, there's the news pages, which I really like because I can go to the news page, say in our affordable housing news, and see all the more recent information on our website. And you would think that wouldn't be something that I would need given that I'm the managing partner of Novogradac, but there's always so many updates. It was hard to keep track of all the different updates that were going on. So now we have the website that essentially is affordable housing breaking news. And we have similarly for our other sort of practice areas. So that's now my homepage.
Yeah. I think it's very user-friendly. I love the new setup. It looks really cool.
No, because
more modern.
I like looking at the New York Times in the morning. I like looking at the Wall Street Journal in the morning, all digitally, of course. I like looking at the daily tax report. And now I have this here as my homepage to be checking every morning to see what's new, either within Novogradac or outside of Novogradac. So thank you for recognizing Brad and Rob on the report, as well as the marketing group and What's Next Innovation on the website.
Yeah.
And
thanks for having
maybe
me.
I'll also note that if as users, as audience members and users of the website, if you identify areas for enhancements, improvements, or just compliments, send those to cpas@novoco.com as well. And with that, thanks for being on the podcast today.
Thanks,
and to
Mike.
our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.